Very good evening to all of you. Welcome to practical session number 26 for the year 2024. Myself, Sujit Kakkar. Today is Sunday, 7th of July, 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So before we move ahead, I would also like to add that we recently started a WhatsApp channels to keep you guys updated with our videos, schedules, any updates if they are coming up or any offers if they are coming up. So if you want to join this WhatsApp channel, you can scan this QR code. Alternatively, you can also find the link in the description. You can click on that link and you can join that WhatsApp channel. Now, today's session will be practical application of demand supply methodology. So our course used to be a paid course, but it's been a while. We have made it now an absolutely free course. So you can learn the complete demand supply methodology absolutely for free. And the link to the course content is available in the description. In fact, during the session, if I talk about some videos, if I talk about some course content, if I talk about some documents, all the links are available in the description. And the course is available in both the languages, English as well as in Hindi. So this is our English channel. The Hindi channel is called as Trading Munch. The link is available in the description. So if you want to learn it in Hindi, you can move to that channel, and that is where you can learn the complete strategy in Hindi. So what we do is that when you go through this course content, you basically learn the demand supply methodology theoretically, right? What is demand? What is supply? What are the things we look into? How do we qualify these demand areas? How do we qualify these supply areas? How do we plan trades, right? All those things you learn in a theoretical way. But unless and until you see practical examples, we don't get the clarity to how they apply the methodology. And that is what we do in these weekly sessions. So every weekend I do one session where we take some example, and to that example we apply the complete methodology so that you get that hands-on experience how trades are to be planned using the demand supply process. So whatever trade, these examples I share with you, whenever they get triggered, we always start with the review of those examples so that you can see the before and after that, when we planned the trade, which is the before, how the price action was looking like, and after the trade got triggered, after the prices came into our demand areas or supply areas, how did the price react from those demand areas, supply areas. We also review them so that you're not just looking at one part of it, which is just the analysis, you're also looking at the outcomes of it. Definitely, I don't share the name of the symbols, and I've already given this reason multiple times because the sessions are intended for you to learn the methodology. If you are understanding the methodology, you can apply it to any symbol. It's not for giving you ready-made trades. So again, I'm here to teach you how to fish. I'm not here to give you the fish, and that is the reason I don't disclose the name of the symbols while we are doing the analysis, but we definitely we review them as and when they get triggered. So today we don't have anything which is pending for review. Whatever got triggered in the past has already been reviewed. And since nothing got triggered during this week, we can straight away start with our analysis for today. So when it comes to trading, I always say trading has to be a very mechanical and rule-based process. Now, it's very easy to say it has to be mechanical and rule-based, but unless and until you create a trade plan for you, you cannot convert it into a rule-based system. And to make that process easier for you, I have shared two documents with you. The very first one is called as your trade plan steps. You can also call it as the flowchart or the walkthrough, which guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, which are available in the rule book. So this rule book is a conservative approach because whenever you're learning something new, definitely makes sense that you start with a conservative approach. With time, with experience, definitely you can make modifications to it to make it better suit with your personality style. So what is our step number one when we start planning our trade? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies what is my expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be a break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason we are doing that is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that we have so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade which can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I definitely said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, then I'm pretty sure you would have experienced whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we keep a position overnight, by keeping that position overnight, we are taking that inherited gap risk, which cannot be avoided. And that is why my recommendation to all of you is that initially, early dailies, do them as strictly intraday trades. Do not keep them as overnight trades and take that unnecessary overnight gap risk. But for weekly monthlies, we are not expecting to get the exit the same day. So here we have no choice, but we'll have to keep these positions as overnight positions. But as you start having more and more experience, you start building up confidence. If you want to do daily incomes as overnight trades, acceptable, it can be done. But do not do it early on. So we would avoid it as a risk management rule initially. But eventually, yes, it can be done once you start having confidence in your analysis. All right, so step number one is to define your trade purpose. And let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic that is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan weekly income trades. So as a monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Intermediate is weekly, used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. ACTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then our refining time frame will be the 60 minutes chart. So as soon as I'm done with my step number one, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. Now mind that this table, which is on page number 31, is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes during the day. But if you're trading markets which are open for longer durations, then you can refer to the table which is on page number 32. So whether you're trading commodities, forex, cryptocurrencies, right, these markets are open for longer duration. So this is the table you can refer to. So as soon as I'm done with my step number one, like I said, now I have the clarity to what time frames I'm using, plus what is going to be the purpose of each and every time frame. So my challenge number one is taken care. Now the next challenge is I do know my time frames, but on the NSE exchange, we have about 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what we need now is a process in place which can help me get a smaller list out of these 2000 companies, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 plus companies every day, not an easy task. So how do I get that small list? For this, we use certain computer programs which are called as scanners or screeners, and they help us selecting some scripts from this big enough array so that we can start doing our analysis. Now, a few examples of these scanner screeners. Example one, if you go to my website, under the free tab, you will see I have created some scanners for you. And those scanners are based on some moving averages. They can help you in shortlisting symbols. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Similarly, on my YouTube channel, search for Sector analysis, you'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners, but you're not only restricted only to these 3-4 scanner screeners. Let's look at few examples before we move ahead. So like I was saying, that once you go to our website, under the free tab, you have the option which is stock screener. Because I opted, I want to plan MIT trades, I can click on MIT, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 3 symbols for me, and the short scan is shortlisting 6 symbols for me. Now, very important, irrespective what scanner or screener you're using, whatever results you get, like here you can see you're getting some results, you can never blindly buy or sell these stocks. Now, just as an example, if this long scan is giving you 3 symbols, does not mean you can blindly buy these 3. Similarly, just because this short scan is giving you 6 symbols does not mean you can blindly sell these 6. The job of the scanner is I can't analyze 2000 plus companies every day. So what it did was it helped me get a list of 3 plus 6, which is only 9 symbols to look into. So now I will have to analyze these 9 symbols one by one. Out of these 9, if anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, nothing is available to me. Now, many times what can happen is the list can be a very small list, or maybe it might not, generate even a single result because nothing is matching with these conditions. So in such scenario where you're not getting any results, or maybe the list is very small, or even otherwise, if you wish that your list should always be a little bigger, because bigger the list, the higher is the probability you might be able to find some really nice opportunities, then what you can do is you can see that in this screener, I have given 5 different conditions. You'll disable the third one, you'll run the scan again. And I'll do exactly the same thing for the short scan, disable the third one, run the scan again. And now you can see that initially it was giving me a list of 3 symbols for the long scan, but now it is giving me around 41. And for the short scan, it was giving me 6, but now it is giving me 13. So we have 41 plus 13, which is 54 symbols to look into. So it's not that you have a list of 500 or 600 symbols to look into. It's still a very small list, about 54, which can be easily analyzed, I'll say, in about half an hour, 45 minutes. Should not take more than that. But yes, this is not the only scanner that is available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available. Few of them are based on fundamental analysis. Then you have your top left, then you have your candlestick patterns, then you have your range breakouts, bullish scan, bearish scan, then you have your intraday bearish, intraday bullish crossovers. So n number of scanner screeners are available to you. Out of this, whatever you feel is the right fit for you, you can use that. And this is example of one simple website. If you do a Google search, you'll be able to find n number of websites, n number of scanner screeners. Whatever you feel is the right fit for you, use that to get your smaller list. So now in this example, you saw that you got a list of 54 symbols, but once you start analyzing them, few more challenges which you will be facing. Challenge number 1 is when you analyze these symbols, what you'll realize is that most of the symbols in this list, they do not have a quality demand zone or a quality supply zone on the lower time frame. And the reason for that is because all these scanners are either based on conventional technical analysis or fundamental analysis, which means just because something is getting shortlisted does not guarantee that there will be a demand area or a supply area on the lower time frame, because these scanners are not based on demand supply zones. And the second problem is that even if some of them, they do have some quality demand supply areas, those areas might be far away from the current market price, due to which you'll have a longer waiting period before the prices are back to your zone. And during that waiting period, what can happen is whatever price action develops, it might disqualify the trade setup by the time it is back into your zone. So these are some of the challenges we face when we have scanner screeners that are not based on demand supply zones. They are based on either conventional technical analysis or fundamental analysis. Now, to overcome these challenges, I've also created 2 custom built scanners. One is called as the alert service, the other one is called as the screener. Again, I'll add, these are not call giving or tip giving services. These are scanner screeners, but they are purely based on demand supply zones. So how do they work? Just to show you examples. If you look at alerts, what alerts they basically do is, as in when we have formation of demand and supply areas, it notifies us that on which symbol, on which time frame we have a formation of a demand area or a supply area. Now for alerts, we do have demo channel. We have demo channel for NSE, we have demo channel for MCX, we have demo channel for Forex. So if you go to the description, you'll find the walkthrough videos for alerts as well as the screener. That is where you'll be able to understand how you can join these demo channels if you wish to. But here is an example from 5th of July. You can see on 5th of July, because we provide the alerts from 11:15 to 11:30 Indian Standard Time. So can you see, as soon as you have formation of some demand supply areas, you keep getting notification. Like in this example, you have on Ashok Leyland drop base rally on the 5 minutes time frame, where this is the proximal value, this is the distal value. Then you have some alerts from the daily time frame. Then you have from the 15 minutes time frame. You can see this, these are at 11:15. Then you have at 11:20. Then you have at 11:25. Then you have at 11:30. So as in when these zones are getting formed live, you keep getting these notifications, and that is what alerts they basically do. But again, remember, just because you're getting these alerts does not mean you can blindly buy at these demand areas or blindly sell at these supply areas. These are not call giving or tip giving services. The job of the scanner here is to tell you during the live market on which symbol, on which time frame you have a formation of a demand area or a supply area. Once you have that information, you will have to match that zone with your trade plan. If it qualifies as per your trade plan, it might be your trading opportunity. If it doesn't qualify, anyhow, you should be skipping it. Now, the other one I was talking about is the screener. So here is an example of screener. So you can see I have applied screener once on the chart. It can be applied multiple number of times depending upon your subscription with TradingView. And here you can see I've given a list of about 40 symbols, and then I'm telling the screener that out of these 40 symbols, shortlist the symbols for me where the proximity of the current candle is within 1% to a demand area or a supply area. And can you see now, out of those 40 symbols, it is telling me that if you're looking for long opportunities, you just have to look at these three, because these three are close to demand areas. So just as an example, if I look at HCL Tech, can you see on HCL Tech, we just had a formation of a demand zone, and that is why it is getting shortlisted for us. And since I'm on the weekly time frame currently, it is telling me based on the weekly chart. If I move on to the daily, now it will shortlist for me based on the daily. So you just change the time frame and you get the list based on that particular time frame. So can you see, if I just wait for a few seconds, I'll get the list for daily. Let's give it a few seconds, because the smaller the time frame, the more the data, and the longer it will take for the scanner to do the analysis and identify for you. So let's give it a few seconds. All right. All right, so it's still taking some time, but not to worry. That's something which is going to happen, because it has to look at 40 symbols and then go through, the complete data available on those 40 symbols. So now you can see you have your results. So if I go to BPCL, you can see on BPCL on the daily time frame, we should be having a demand area somewhere close by. Can you see you have your demand area? That is why it got shortlisted. And now you can see you don't have to again analyze 40 symbols. If you're looking for demands, these are the symbols. If you're looking for supply, the ones which are highlighted in red, those are having proximity to the supply zones. So this is what your alerts and screener is all about. But again, I'll add, these are not call giving or tip giving services. These are just some tools which are helping you shortlist symbols based on demand supply zones. So again, step 2 is to get a smaller list for you. Now how you get that small list is completely your choice. I showed you a number of tools, over 150,000 scanner screeners on just one simple website. Two of these scanner screeners which are based on demand supply zones. The next way can be as simple as, I don't want to use any of these scanner screeners because I want a small list. I will only be analyzing my Nifty 50 stocks almost every other day. So it's your call how you want to identify your list, but I just showed you a number of ways to do that. So yes, once you are done with your step number 2, what is going to happen? You'll have a list with you. From the first step, we already know the time frames, which is monthly, weekly, daily, and 60. So now I know my time frames. I know the symbols I should be analyzing. So what I'll do now is I'll move on to the next step, which is go to the lower time frame. So the question here is, what is my lower time frame? And from our step number 1, we got to know, as a monthly income trader, my lower time frame is daily. So we'll start with the daily time frame. And what we need to do on the daily time frame, we need to identify any of these 4 structures, which can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So let's assume whatever the list we had, the very first one was ABC. So we'll go to ABC, right? And we'll start with identifying the zone. Now, when you started learning demand supply methodology theoretically, we started with a concept which is called as boring exciting candles, because you will see most of the zones can be identified based on boring exciting technique. But if you think about it, the demand supply methodology is more based on price action. So what do I mean by price action? Price action means what action price has done, and price can only do 2 things. It can either move up or move down. It cannot do anything else. But when the price is moving in a narrow range, we call it as the period of pause, or we can also call it as our base. Now, initially, when our eyes are not trained, that is the time we are using the concept of boring, exciting candles to identify that basing or you know the period of pause. But as you start having more and more experience, you will start shifting from period of pause and basing, sorry, from boring exciting to where do I see that period of pause. So here you can see, if you're just visually looking at the chart, you can clearly see prices, they moved up, we paused, we started moving up. That's a rally based rally for you. And the fact is, even if I apply the explosive move indicator and the boring candle indicator, now the boring candle indicator will convert all the boring candles on the chart into blue color, and the explosive move indicator will convert all the explosive candles into black color. These colors can be customized, but these are the default colors. So you can see, even if I was using price action, I could see this rally based rally. If I'm using boring exciting technique, I know I have an explosive candle, which also implies it's an exciting candle. Then we have this boring candle, and then we again have an exciting candle. So the exciting candle to the left of the basing is your leg in, this is your basing. To the right we have our leg out. So even by using the boring exciting technique, we have been able to identify this rally based rally structure. And of course, if you're using the demand and supply zone indicator, it automatically identifies the zone for you, automatically plots these zones for you. And yeah, these are few ways how you can identify your zones. But yes, I prefer to lean purely against the demand and supply indicator because it makes the process faster, easier, and also keeps it mechanical. But yes, it's not mandatory. There are a number of tools, like I showed you. I have created some free tools for you. You can even do it visually, wherever you feel is the again best fit for you. You can do your analysis based on that. So step 3 was to identify the zone, and now we have identified the zone on the chart. So I'm done with my step number 3, which is identify zone. Do we have a zone available? The answer is yes, we do have a zone available. Now, once you have identified the zone, does not mean you can blindly buy at any demand area or blindly sell at any supply area. And that's the biggest mistake demand supply traders, they do initially. They find any demand zone, they start buying. They find any supply zone, they start selling, which is incorrect. Once you have identified your area of demand or supply, the next step is to qualify it. And once you have qualified it and it matches with your trade plan, only then you can go ahead and use it, right? So when we do the qualification, we do the qualification by using a two-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify using the booster scoring. So starting with the first step, we'll check whether the zone is a case of level on top of level or not. Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area, and that is why we start with level on top of level as the very first condition. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand here is that to be a case of level on top of level, my lower time frame zone has to be part of the intermediate time frame zone, and this is what we also call as a coinciding level. So if you have a coinciding level, you might have a case of level on top of level, but if you don't have a coinciding level, you cannot have a case of level on top of level. So let's verify the zone we have identified. Does it coincide with any intermediate time frame zone? And you can see that as a monthly income trader, my intermediate time frame is weekly, and on the weekly we don't have any zone in this area, therefore we don't have a coinciding zone. So if it is not coinciding, it cannot be a case of level on top of level. So yes, we have already verified level on top of level does not apply, not because of a gap. Pivot nor authenticity not applicable, because we only apply pivot nor authentic to a drop based rally or a rally based drop. And unstable equilibrium is also not applicable. So none of these conditions are getting applied. Now, if these conditions are not getting applied, they cannot disqualify the zone. If they get applied, then there are two possibilities, either qualified or disqualified. But if they are not getting applied, the zone cannot be disqualified. So is the zone qualified for us? The answer is yes, because none of these conditions, they disqualified the zone for us. So since the zone is qualified, now we can move on to the next step, which is the booster scoring. So starting with the first one, which is freshness, we can see the zone is fresh, gets a score of 3. Strength, we have an explosive move, gets a score of 2. Time at the zone, we only have one candle, gets a score of 2. Reward to risk ratio will be taking as an assumption. Now talking about location, we are definitely planning the trade at the best location. You will see the indicator will mark the demand zone for us. So that's your drop based rally. So we are planning our trade inside of it, which gets a score of 2. trend becomes irrelevant because you're at the best location. At best location, doesn't matter whether it is uptrend, downtrend, or sideways. All three of them can be traded with a score of 1. But just in case you want to see what the trend is, you can go to your intermediate time frame. The indicator will automatically tell you, since we have a down arrow and an up arrow, this basically tells us we are in a sideways trend, which gets a score of 1. Move from the zone, we need minimum 4:1. If you now look into it, you can see we have been pretty close to it. You can see very close to it, but not an exact 4:1. That is the only reason I'm giving it a score of 0. Otherwise, if you go from exactly the proximal and the distal, you will have 4:1, but going from the entry, which will be a little above, and the stop loss, which will be a little below, we don't have a 4:1 move, and that is the reason I'm giving it a score of 0. But if you want to be a little aggressive and want to give it a score of 2, it is still acceptable. I'm just being very conservative, right? Now, level on top of level, we have already verified. It's not a case of level on top of level, not even coinciding. And even if we talk about trap, we don't have anything which is really nice, because if I start from the proximal, start pushing it up, you can see this area in the recent past has definitely acted like support. In the past, you can see it has acted like resistance. But now if you start going back, you can see prices have just been, moving up and down, whipsawing this area as if we don't have any area of support and resistance here. So because of this ugly looking past, I would not say that we have a very clean area of support and resistance, and that is why I'll give it a score of 0 for trap. So if you look at the overall scoring, we have a score of 10 out of 10 for quality, definitely with the assumption of reward to risk ratio, and 3 out of 8 for probability, which makes it as a high quality but low probability trade setup. But like I already said, we are pretty close to 4:1. So if you want to be a little aggressive and want to give it a score of 2 to convert it into a type 1 trade, I'll still say acceptable, but let's just be conservative as of now, going with the trade plan, where if we don't see an exact 4:1, we'll give it a score of 0. So yes, after applying the boosters, we got to know that this has to be done as a type 2, type 3 trade as of now. Yes, eventually if the prices, they move up and then come back into the zone, it might get converted into a type 1 trade. Now the next step is, no matter how high the quality or the probability, we understand any trade can be a stopped out trade. So you need to be ready for the worst case scenario, where we'll do our position size calculation. Once the prices are back, we'll have to double check, because markets are not static, markets are dynamic, and we'll have to verify before placing our order, entering the trade, that does it still qualify based on our trade plan. If the answer is yes, we place our order type, and once your order has been executed, the last step will be your trade management, where step 1 is 1:1. We make it as a break-even trade, and after that, if we get the opportunity to trail onto it, we start using a trailing stop loss, TSL, unless and until we get the exit. So this is how we plan trades, very mechanically, very rule based, and that takes care of our today's practical example. Now, before I move on to the questions, queries we have in the chat box, I would definitely like to add, if you're not subscribed to my channel, do ensure you subscribe to it, so that you get the notifications whenever I'm doing these sessions. Plus, if you're liking these sessions, do hit the thumbs up button. And if you have some friends, family members who are into trading or interested in learning trading, you can share the link to my channel, to my course content, to my videos. It might prove helpful to them. So let's see what we have in the chat box. All right, so the very first one is from Ram Mohan, and he says, all right, very good evening. Again, I'll say very good evening to all of you. Please explain alerts given in Telegram channel, and how to place multiple orders given by SK alerts. Okay, so the first thing, like I already said, alerts are not calls or tips. They are not buy or sell signals. Alerts is purely a scanner which is helping you shortlist symbols, where in real time demand and supply zones are getting formed. Once you get those notifications, like just as an example, if I go back and show you the example here. So just as an example, at 11:15, we got an alert on Friday that on Ashok Leyland we have a drop base rally, which means we have a demand zone on the 5-minute chart, where this is the proximal, where this is the distal. So now you know that on the 5-minute chart we have a formation of a drop base rally. Now if let's say you're a DIT trader, right, who's doing DIT trades, now you know this alert can be useful to you. So what you'll do is you'll go to Ashok Leyland, you will open the chart, you will mark the zone, and then you will do your complete analysis and check, does this zone qualify based on my trade plan? If yes, It can, in fact, I should have said HIT trader, right? If you are an HIT trader, this could have been an alert for you. Now, as an example, now you can see for Lupin and for Loris Labs and for HCL Tech, we had the alerts on the daily time frame. So now these alerts can be useful to somebody who's a monthly income trader. So you know that this is where I have alerts. So now I can go to those charts. I can do my monthly income analysis for these zones. If any of these zones they qualify as per my trade plan, they can be your trading opportunities. So again, these are not calls or tips. These are, uh, you know, scanners which are helping you shortlist symbols which needs to be qualified based on your trade plans. You can never blindly trade them. So always remember that. All right, so next is if the lower time frame zone coincides with the intermediate time frame and the intermediate time frame has been tested, should we still consider this for trading? All right, so that's a very interesting question because this can happen many times. So this might be your intermediate time frame ITF. But on the lower time frame, your zone can be a little, lower. So this might be tested, but the lower time frame zone is LTF is still fresh. So should I be trading it? Should I be avoiding it? Now again, it all boils down to many factors. Very first factor can be your personality style. If you're a very conservative trader, you might say, okay, because I can see that the intermediate has already been tested and this is a part of it, I would not like to trade when the prices they come back again because it's a tested zone. Another example can be, let's say if we had a case of level on top of level, then I might not mind because that negative factor which the zone is already tested, I have some positive factor level on top of level to support me. Another example can be if this is happening, let's say very low of the curve, I might still be okay with it because I know at least I'm having the support from the higher time frame. So it all boils down to, yes, you do understand that the test of the intermediate time frame is already a negative factor. Now, because of this negative factor, do you want to avoid the trade or do you want to look for some positive factors? Like I gave you two examples. It could be level on top of level, LOTL. It could be your location. So if you have those positive factors and you want to use those positive factors to rebalance this negative aspect and want to go ahead and take that trade, absolutely, it can be done. So again, like I said, all boils down to your personality style, how you are adding that positive factor to that negative factor which you're already looking into, and based on that you can make your decisions. But definitely if the zone is tested, we know the probability has gone down. You need to increase that probability by using certain factors, or maybe as a very conservative trader avoid it altogether. All right, is it necessary for the lower time frame zone to be within the range of the higher time frame curve when marking it? Should the lower time frame zone always reside between the high time? See, ideally, it is something we need because if you think about it, if you have your higher time frame, let's say this is the HTF supply zone and this is the HTF demand zone. Now what happened is once you went to the lower time frame, probably in this range there was no quality area on the lower time frame. Maybe your lower time frame demand zone was here, right? This is your LTF demand zone. So now if I have to plan my trade, I know this is where I have the lower time frame quality area. That is where I should be planning my trade. But as long as we have this higher time frame demand zone, supply zone, from here prices can move up, from here prices can move down, and I might not get the opportunity. And once this demand is violated, right? Now what can also happen is the location of this zone might not be at a very good location. Now the example for this can be, I don't have a lot of room, but probably the next demand area is very very far away, right? Somewhere at the bottom, really really far away, which still puts this lower time frame zone closer to the supply, which might be high of the curve location, right, wherein I might not want to use it. So yes, if the zone is outside of that range, you will have to wait for the violation to happen. If you have a zone in between, you might have an opportunity. Otherwise, you'll have to wait for the violation to happen before the prices are back. And plus, you'll also need to ensure that when you're using that zone, you're still at a location which is conducive to you and is qualifying based on your trade plan. But yes, it can happen. At times, there might not be any quality areas within the curve and the zones might be outside of that range. So now you have no choice but to wait, right? Wait for, two things, either the zones to get violated, the higher time frame zones to get violated, or maybe a formation of a new zone eventually on the lower time frame, right? Those are the two possibilities. All right. When marking zone at lower time frame, how far back should we consider older zones? I have noticed that demand supply indicator often marks quality zones. Yeah, see, it has no limitation that it has to be just 1 week away or 1 month away or 6 months away. It can be 10 years ago, it can be 20 years ago, it can be 50 years ago, doesn't matter. As long as you have those zones available to you, you can use them. There is no limitation to the time. So they do not get disqualified based on the time. They will only get disqualified if they don't match with your trade plan. No qualification criteria based on how far back or that demand area or supply area is coming from, so that does not disqualify the zone. All right. In the past, price may not reach there most of the times. Yes, it can happen, but again, if the price is not reaching those demand areas or supply areas, eventually you will have new demand supply areas getting formed on the lower time frame, and that is where you can again revise your zone, and again you can again replan your trade. So those things will happen, but yes, if the prices don't give you those very deep corrections, just wait for new zones to form, and then you can plan your trades. Plus, that will probably not be the only symbol available to you. There are a number of symbols, so somewhere or the other, you'll be able to find some opportunities. Don't worry about it. All right, suppose one of my zone is past level on top of level, gap not authentic, but did not pass the unstable equilibrium. Still, can we consider the zone for trade, or should we see again, like I was talking about, if you have some negative factors and if you have some positive factors to balance that negative factors, absolutely, why not, right? But again, it boils down to how conservative or how aggressive you are. So now, as a very conservative trader, let's say if I see unstable equilibrium zone, as a very conservative trader, I might not trade it. But if I'm not very conservative, I can see, okay, this is also a case of level on top of level. Or maybe I can see this zone is located at the best location. Or maybe I can see that from the zone I have got moves which have violated maybe zones of some bigger time frame. So those positive factors can again give me that confidence that yes, probably I can use that zone. So again, it's always looking at the whole picture and understanding what are the positive factors, what are the negative factors, and then you see based on your personality style, what do you want to give more weightage. Do you want to give more weightage to those negative factors, or do you want to give more weightage to those positive factors and go ahead and take that trade, right? So what we are doing is we are basically trying to understand the complete picture, and then based on our personality style, make those decisions. All right. In the past, zones price okay reached there. Okay, I've already answered that. I've answered this query as well. Sometimes I've observed that during the trade plan, the trade on the intermediate time frame, the trend on the intermediate time frame is up, but when the price reaches the zone, the trend changes to a downtrend. See again, yes, this can happen, but again, if you think about demand supply methodology, I have said this many times that in demand supply methodology, trend does not have a lot of weightage, right? Initially, when we are starting with the process, we want to give it a little bit weightage because the more factors we have in our favor, the better it is for us. But if you think about trend, what is basically trend? Trend is basically your movement of price between your demand areas and supply areas. If you're an uptrend, price hits a supply zone, a downtrend can begin. If you're in a downtrend, price hits a quality demand area, an uptrend can start. So your trends are always after the fact. So that is the reason, not a lot of weightage. In fact, if you see the analysis we did today, I talked about we are at the best location. So it doesn't matter whether it is uptrend, downtrend, sideways. In all the three cases, it is going to be a score of 1. So yes, all these factors, they definitely play. But eventually you will see that not a lot of weightage has to be given to the trend. But yes, initially having that a little extra factor can support your trades, and that is why we do add it in the booster scoring, so that initially you have that extra weightage. Eventually, if you want to ignore it, not a very big deal. All right. Let's see what do we have next. Thanks a lot for the live session. I've just seen your live and live video. A small favor of yours, because you're my first mentor of stock uh, business. All right, thank you so much for your feedback. Let's see. Requested someone to do a podcast with you. All right. So thank you for your appreciation, Devbhumi Traders. Let's see what else we have. Nifty 50 stocks, Nifty 50 mostly stocks are bullish on HTF. Price always follows high time frame. See, yes, that is what I always say, that the bigger the time frame, the higher the weightage. So absolutely, if you are giving more weightage to the higher time frame, you will always be having a little better result, if you give a little extra weightage. But yes, at the end of the day, you also have to remember what kind of trade you are planning. Now, a very simple example can be that even if I'm in an uptrend on a monthly chart, we might get very small corrections during intraday, which can help me get maybe some short opportunities if I wish to, right, before the prices they again turn back and start moving up. So it all boils down to how aggressively, again, conservatively you want to plan your trades. But yes, the bigger the time frame, the higher the weightage. I'll definitely agree with that. All right, so stock business is all about demand and supply, where price moving upwards and creating higher price. Yeah, all right. All right, so yes, I can see it's a few feedbacks and some insights you're sharing. So let me see if there is some queries. I'll definitely answer that. Uh, all right, so happy to know that my videos have been helping you. All right, so I'm just going through your messages. I appreciate your feedback. But again, if there are some questions, queries, I'll answer them. But again, Devbhoomi traders, appreciate your feedback. All right, great. All right, so let's see. That's right. All right. Mhm. Locked in. Okay, thank you. Great. I'm using the demand supply zone indicator for the first few days, and it's awesome. So, no IT free, right? So, like you said, you have been using the indicator for the first few days, and it's awesome. But again, I'll like to add, and this is something I keep saying over and over again, whether it is the demand supply zone indicator or the scanner or the alerts, always consider these are your decision making tools, right? These are not tools which are giving you buy signals or sell signals. So if you're using it the correct way, definitely you can get good results, but do not assume that wherever demand areas or supply areas are getting marked or getting shortlisted, you can blindly trade them. So again, please don't trade them blindly. Always use these tools as your decision making tools. They are not call giving or tip giving services, right? So use it the way they are intended to be used, not blindly, right? That is one thing which I'll definitely like to add here. All right, great. um, okay, so no IT free. Like you said, if I can start some Telegram or WhatsApp group where we can share, our trade plan. The problem here will be that for me, once you have a lot of people joining in, to go through your trade plan and comment on it and help you with it individually would be very, very challenging, right? So I don't want to get into something which eventually will not be fruitful to you, because I know that it's going to be a very big challenge to go through whatever people are posting there and helping them out, and it's not something I can give a third person the task of doing it, because if they don't have good understanding of it, like my staff, they can't do it. They are not traders, right? They can only help you with maybe if your subscriptions are not working, or stuff like that. When it comes to analysis, at the end of the day, I'll have to look into it, which would not be humanly possible for me. So that is the reason I don't want to get into something like that. All right, so apologize for it. All right. So I'm only training my eyes for demand, supply, and price action. Perfect, right? There is nothing wrong with it. So I always say, see, these tools are there, but these tools are not mandatory tools. So if you feel that you want to train your eyes eventually and you just want to trade based on that without using any of these tools, acceptable, right? Nothing wrong with that. All right. All right. So let's see. Perfect. So that basically answers some of these questions, queries we had in the chat box. And again, thank you so much for your appreciation. And I'm happy to know that these sessions are helping you. And again, my tools are also helping you. But for the tools, I'll definitely add, don't use them blindly, because they are not giving you buy sell signals. Always use them wisely, the way they are supposed to be intended to be used, by just helping you, assisting you in identifying the opportunities which later needs to be qualified based on your trade plan. So again, thank you so much for joining in. I'll be seeing you next weekend. Till then, trade safe, take care, bye bye.